try again. I'm going to call the meeting to order. I'm Chris Christensen. This is Jack Balcom. We're the trustees of trust funds. Bill Wilkes is on a plane this morning, so he can't even join us by telephone. And I think we'll just start down in the corner. Paul, if you would begin introductions.
Paul McCallie, Finance Director and Assistant Town Manager for the Town of Merrimack. I am filling in for Tom Boland today.
Michelle Holton, there we go. Michelle Holton, Finance and HR Director for Merrimack Village District.
Judy Noel, Cambridge Trust Company.
Eric Jusome, Cambridge Trust.
Lindsay Donovan, Cambridge Trust.
Okay, thank you all very much. And I apologize, I never can remember. EY or AY?
EY.
Got it right, okay.
My daughter's name is
That helps me a lot, Jack. Okay, first order of business is the minutes of October 25th. Jack, do we have a motion?
I move that we accept the minutes of October 25th.
And I will second.
I got a green light. Oh, there we go. Okay, I move that we accept the minutes of October 25th.
And I will second. All in favor?
Aye.
Aye. And we're going to dig right into it with a presentation from Cambridge Trust.
Okay.
Who's first?
I'm going to talk about the markets and the economy, and then hand it over to Lindsay to go through the portfolios.
Okay.
But starting on page 2 in your books, just trying to put into perspective, it's been a really good year for the markets. Equity markets, especially the S&P 500, it's up about 25%. And notwithstanding, bond returns have been really strong as well, as the Fed has gone through and reversed 3/4 of the rate hikes from 2018. So they've had 3 rate cuts this year. So we had last year at this point, we had an inverted yield curve. So the Fed actually ignored the warning signs from the market and went ahead and had the final rate hike in 2018 in December of last year. We had a lot of turmoil in the markets. Fourth quarter last year, we had a 20% drop in the S&P 500. Coming into this year, the Fed had talked late last year, coming into this year, possibly 2 to 3 rate hikes. I like to say they went on their January apology tour and basically reverted back to, we're data dependent, we see what's going on in the market, and they've had 3 rate cuts. So essentially the the yield curve has re-steepened. It's not a really steep yield curve. If you look at the yield differential between the 2 and the 10-year Treasury right now, it's about 15, 16 basis points. But again, that was slightly inverted. And more importantly, if you look at the 3-month to 10-year, over the summer that was inverted by about 50 basis points. Now that's positively sloped as well. So the markets have reacted. So bond returns have been strong. Stock returns have been strong as well. What page 2 is showing you, since the March 09 lows, the S&P 500 through the end of Q3 was up 342%. So it's been a very long recovery in the U.S. If you watch CNBC, everybody's saying, we're going to have a correction, and there's a couple of charts in here we get to and we'll look at. So each year the market does have volatility. It doesn't go up every single day, even though it seems like we've had a really nice run here. There is periods of inter-year volatility where the markets are negative. But this year, the volatility's been, not as much on the downside, but it's been a really strong year. Part of the reason on page 3, just looking at the valuations of the market, if you look at the forward PE right now, as of the end of Q3, it was trading about 17 times earnings. So slightly over the mean, but well below the 1 standard deviation that was trading closer to back in 2016, 2017. So the market as a whole, it's not cheap, but it's not dramatically expensive either. So it's sort of trading right in line with its 25-year average. And just looking on page 4, the returns and valuations by style. So this basically takes your equity capitalization of small, mid-cap, large-cap stocks and breaking it down by value, growth, and blend. And for the common trust funds that we manage, they mostly have a blended tilt. So looking for more dividend-paying stocks, which tend to have lower volatility because of the higher dividend yields. But even still, those returns are still in the 20% area. So what this chart is showing you is, if you look at the year-to-date columns, most asset classes except for small cap value have really strong returns, in the 20-ish% area. And when we get to the actual performance, Lindsay will show, the common trust funds are, having really good years, having a really strong year as well. One area that we're starting to do a little more work on is on page 5, international equities. Trading relatively cheap when you compare it to domestic stocks. There could be a reason why, but again, the world hasn't ended in Europe. We're actually starting to see a little more signs of stability, especially in Germany. We even know their PMIs are still below 50. They've actually had 3 consecutive months of increases. So we may have bottomed in Europe and starting to see an upswing. So we're starting to do a little more research and maybe add some international exposure to the portfolio as we move through 2020. One of the reasons why we think, everybody's talking the stock market is, expensive and maybe in for a downturn. We're not on that camp just yet. So if you look at the earnings yield versus the S&P 500. So the S&P 500's earnings yield on page 6 is about 6%. S&P in the 10-year Treasury right now is about 1.75%. So in that metric, the stock market is actually not as expensive. You could say the bond market is more expensive compared to the stock market right now. Another reason why we think stocks are pretty well supported here is about 60% of the S&P 500 has a dividend yield greater than the 10-year U.S. Treasury. So it's the highest it's been since back in the early mid 2010 2007 area. So companies have been doing well. About 72% of companies that have released third quarter earnings beat estimates, and you're starting to see more dividend increases. So we think the market right now is not overly expensive. Full disclosure, coming into 2019, we're expecting the market to have about a 7% return. And an average right now it's 25%. Don't think we'll see a 25% return next year, but we still think there could be multiple expansions heading into next year, which could give some really typically the markets average between 7 to 10% over a course of a cycle, where we could see more reversion to the mean, but still positive returns in 2020.
Now, are you referring to all sectors, or are there some sectors that are really going to explode next year?
Well, we still think tech. Tech is a very attractive area to be in with the new technology that's coming on, and also bear in mind we're having a presidential election cycle moving into next year. We're not making any dramatic changes, but if you look at the potential candidates and what their platforms are, there will be sectors that will be under pressure and sectors that may do well depending upon who the ultimate candidate and the ultimate president becomes a year from now.
I forgot about that. Jeez. Just when we thought we were seeing some stability.
Yes. So, as I was mentioning earlier on page 8, annual returns and inter-year decline. So the market does not go up every day. We've had a really strong year. So you look over on the far right of this chart under the YTD year to date. So at the end of Q3, the market was up 19%, but its lowest point this year it was down 7%. So you've had some volatility. If you look to the the bar chart, the bar line to the left, so last year the market finished down 6%, and at its lowest point it was down 20%, which was the Q4 area. So each year there is going to be inter-year volatility, but if you have a long-term horizon like these funds are, you can withstand the short-term volatility that may happen. Not surprising, on page 9, the length and strength of the economic expansion. So this current economic expansion is 124 months long. So it's been one of the longest expansions in U.S. history. And I'm going to focus on the chart on the right side. If you look at that bottom blue line, that is the current economic expansion as measured by cumulative GDP. So you have the number of quarters going along the bottom axis, and the vertical axis has the cumulative GDP. So if you look at the bottom blue line, so it's one of the longest recoveries in U.S. history, but as measured by cumulative GDP, it's one of the most subpar recoveries on record. So it's been a very elongated recovery. We seem to have averaging about 2% GDP and about 1% inflation during this recovery. And, bear in mind that, the Fed has a dual mandate of full employment and low inflation. So for all intents and purposes, the unemployment rate at 3.5%, inflation running at 1%, the Fed has achieved their dual mandate. And 2% growth with 1% inflation is not a bad situation to keep, as people say, muddling through right now. Interesting chart on page 10, economic growth and the consumption of GDP. So about 70% of U.S. GDP is consumer consumption. So as long as the consumer continues to spend, the U.S. economy will continue to move along in this 2% area is what our expectations are. And consumer, retail sales for October were much stronger than September's, and it looks like the holiday season, at least, from earnings reports from Target and Walmart, have been really strong. Home Depot had a little bit of a blip, but that was more due to comps. But overall, you're looking at a stronger, strong consumer, especially in the U.S. The reasons for concern are on page 11. If you look at manufacturing momentum, so the way to read this chart is green shows purchasing managers index or manufacturing activity above 50. So the line of demarcation is 50. So above 50 shows like expanding economy, below 50 a contracting economy. If you look at most of your developed and emerging economies going down the vertical axis. So if you look in 2017 into most of 2018, most of those global economies were green, which showed expanding manufacturing activity. Trade war talk started, third quarter last year, and you can see as you move to the end of 2018 into 2019, a lot of those greens moved to lighter green, or in some cases yellow. If you look at Germany, to red. So you've seen what was the phrase synchronized global growth is now more or less moved to synchronized global slowdown. All the economies are interrelated, but the biggest concern is this trade wars looks like it depends on the tweet of the day or the moment, where it sounds like there is some sort of a framework in place for phase one, but again they have yet to sign the document, and just the trade representative from the U.S. is actually off to China this weekend to try to hopefully finalize the phase one. On page 12, unemployment and wages. Again, as I mentioned earlier, the economy is at full employment. However, there's not a lot of wage pressures right now. Average hourly earnings are running under 4%. For a full employment economy, you should see more wage pressures, which could be the Amazon effect and innovation, where it's just driving productivity higher at the expense of wages. Inflation, again, on page 13. This shows, inflation running well below the Fed's 2% target, and even over the average during this time period. You're looking at inflation about 2.5% to 3%, or 3.5% to 4%, and we're still running about 1.5% right now, as measured by CPI. And then just quickly on page 14. So this is a research report from a firm that we subscribe to, and what they're saying is, if you look at Australia has been in this long recovery of about 20 years without a recession. And what this chart is showing, if you take the triple B rated spread, so the BAA rated spread, so the lowest rung of investment grade credit, you look at that spread, which is the incremental yield pickup over the Treasury. As spreads widen or increase, it's usually a sign of stress in the corporate bond market, which could be related to an economic slowdown. So what this chart is saying is we've had 3 mini recessions since the Great Recession of 2008, 2009. We had maybe, a recession as defined by the NBER is 2 consecutive quarters of negative GDP growth, where maybe we've had 1 quarter of negative GDP growth, or 1 or 2 quarters of slowing growth, and then we rebound. So what this is saying is we've had 3 mini recessions since the financial crisis, and we have yet to have, or maybe we just don't have a full-blown recession, where we have periods of economic weakness, and maybe there's some fiscal policy or monetary policy that rights the ship towards stronger growth. Briefly on page 15, this chart, unfortunately, it's outdated, as we've seen a re-steepening of the yield curve. So the top line is the yield curve as of the end of 2018, and the green line was as of the end of early October. So you can see, if you look at on the green line, so the beginning of the yield curve, so the 1 month out to basically the 10-year was inverted. So short rates were higher than long rates. And what we've seen happen with the Fed intervention with the additional rate cuts is short rates have now moved, or front-end rates have moved now down towards Fed funds, and long rates have moved slightly higher. So you've had a re-steepening of the yield curve. And historically, when the yield curve has inverted, it's about a 1 year to 14-month window where the U.S. economy has moved into a recession. So with the re-steepening of the curve, again, it was a very small period of time which the yield curve was inverted. The hope is that, a steeper yield curve will lead to more economic growth.
Okay, so this is a predictor?
It's one of the leading indicators. So historically, when the 2/10, so the yield differential between the 2 and the 10-year Treasury inverted, on average is about 14 months towards a U.S. recession. So we inverted very slightly for a couple of days, and it wasn't a full-blown recession, a full-blown inversion. Looking at a yield curve inversion of about 5 or 6 basis points. It wasn't like -20 or -30.
So how long do you think, if we see this again, how long does the inversion have to be in place before it
Usually,
has any effect as a
usually
reliable predictor?
Yeah, usually several weeks, more than a couple of days. So again, it's a metric we continue to watch. It's very well spoken, in the press and in the media.
Yeah. Do we get any alerts from you guys when we do have predictors? As far as what moves we should make, as far as...
Well, we're using our discretion to manage the portfolios accordingly.
Oh, okay.
Yeah.
I see. So you take action.
Yeah, so what we remember last August, for one of the trust common funds, we actually reduced the equity exposure. It had a 60% target, and it bumped up into the low 70s. So we used that as a point to reduce that equity
Okay,
exposure.
I can recall that, yeah.
Yeah, so we will, if there's times where we think there are some measurements, we will do so.
Right.
But a lot of the short-term money that we run, it's a 1 to 3 to 4 year ladder. So there's not a lot of that we can really do differently. We can extend a little bit. Maybe if we think rates are lock in longer rates in the 3 to 4 year part of the curve. But again, it's just it's a ladder where there's money that is needed during the course of each successive year. One of the reasons why when we look at the accounts, why we're not putting a lot of corporate bonds in the portfolios is we think credit spreads right now are very tight. They're near historical lows, especially we're at the intra-year low right now. So there's not a lot of, we think, opportunity in the credit markets, which is on page 16. And one of the other reasons is you look at the leverage in the especially in the investment grade index, the weighted index, the weighted leverage has increased to about three times. So we're concerned about the amount of leverage. So during this period of cheap interest rates, companies have extended and put more bonds or more debt onto their balance sheet. So the leverage has increased. And the concern is if there were to be an economic slowdown, would they be able to service that debt? Just quickly, the repo market on page 18, as everybody, or hopefully everybody was aware, we had a short-term spike in repo rates late September, and since then the yield has actually come back down to where it was pre. So there was 3 factors that came into play there. So the repo is the overnight lending market. So corporations that are typically in the market were hoarding cash for their third quarter tax payments. Banks that are also in the market, they actually had to keep cash on the balance sheet as part of their capital requirements. Yeah. At the same time, the Treasury was in the market with record Treasury issuance. So you had 3 factors that sort of drove rates higher. The reason why we continue to watch this, the last time short-term rates spiked this high was when Bear Stearns and Lehman went through their failures, or went through their crises.
But this happened in September.
Happened in September. It was about a 3-day window, and then the Fed is now in the market buying about $60 billion a month to try to put more liquidity in the market. So the clearing level for the overnight repo market is about $1.5 trillion, and because during that time period of less participants, the clearing level dropped to about $1.2 trillion. So the Fed's now in the market supporting their, adding more liquidity to try to bring that level back up to $1.5 trillion. I'll skip on page 19. We've talked real and nominal rates continue to be low. And on page 20, just the last chart here, strong returns in fixed income, as I mentioned earlier. Not just a really strong equity market, but also, bond returns are also positive as well. And In the case of investment grade, if you were invested in, triple B rated 20-year corporate bonds, your returns would be right in line with equity returns in the low 20% area. So even in this low interest rate environment, bonds are still generating positive returns. And with that, I'll hand it over to Lindsay to run through the portfolios.
Great, thank you. So on page 21, this is a consolidated account summary of all of the portfolios of Merrimack that we manage at Cambridge Trust. So in all, the relationship is $20.2 million at this point. Moving on to page 22, we can go into an individual look through at the individual portfolios. So the first one listed here is the Merrimack Scholarship account. The total market value is $255,000, and the estimated yield on the portfolio is about 2.5%. Estimated annual income off of this portfolio is $6,400 thereabouts. We do have about 12.9% in cash right now. It is a growth account, so it's a little bit underweight to equities versus the target. 64% versus 70%. So we do have a little bit of extra cash sitting there.
And this is the time of year we spend it, so that's
Yes,
okay.
Right.
exactly. Moving on to page 23. This is looking at the performance details of this account. So I'd like to highlight on a year-to-date basis, that top line is the total performance of the account. We've had 17.8% return on a year-to-date versus the taxable growth benchmark, which is 17.05%. So that's an outperformance there. Moving down to the equity portion, equities have returned 24.2% versus the S&P 500 up 23.2% here. So that's an outperformance of over 1% on the equities. We've also had strong performance on the bond side, up 8.7% for fixed income versus 6.8% for the benchmark. So really strong performance for this account. We move on to page 24. Looking across the various sectors, this is looking at, in the left-hand most column, what the weights are of the Merrimack Scholarship account in the various sectors, and the column second from the left is looking at the benchmark weights. The third column is looking at the variation, so the variance between the two. So one of the things that our equity team does is look at what are the opportunities in the market and scale up or scale down on various sectors depending on where they're seeing opportunities and where they're seeing opportunities of things that are undervalued versus overvalued. So as the performance on the last page shows, they've had really strong performance this year in different selection.
Looks like utilities and real estate are doing pretty well.
Yes, so down at the bottom, those are both up in the 40% range. So if you look over to the third column where it says variation weight, you can see that we're overweight to both of those sectors by about 1% for real estate and about 3.3% for the utility sector. So if you go all the way over to the last column on the right, you can see the total effect of those changes. So 64 basis points for real estate and 1.45% for utilities that it's adding
That's surprising.
to performance.
It's been that hunt for yield, so you had a sort of a sector rotation, in the middle to the end of the third quarter where growth started to roll over and value started to pick up. So REITs have actually been really strong. We added to REITs about a year ago, more in a valuation call.
Yeah.
You may start to see some trimming of REITs as we move later this year into early next
I
year.
would think if interest rates go down, real estate would.
In the reach for yield, real estate, but if you look at the valuations right now, REITs are getting a little expensive, so it may be more on a valuation call that we'd start trimming some of that overweight.
By the way, thank you, Eric, for your portion. I forget to mention that.
You're welcome.
But this stuff is great.
Great, great.
Yep.
If we look at page 25, this is going through the fixed income holdings. The Merrimack Scholarship account is invested in bond funds. So if you look at the very last row, this shows the totals. So on a yield to worst basis, it's showing a 3.8% yield on this portfolio. And the duration is 5.5 years. If you move on to the next page, 26, this is a shock analysis that we've done on the fixed income portion of the portfolio. So this is looking at how the fixed income portion of this account would react given different simulations of the yield curve moving. So the very middle line is, the very middle column is looking at no change. So what would happen if there were no changes to the yield
Okay.
curve?
No change, okay.
So in that case, the total return would be 3.8%, so the same as what the current yield is. If you move over one to the right, this is looking at what would happen if rates went down by 25 basis points in the short end and went down by 50 basis points in the long end. And in that case, the portfolio would outperform. So we would have a 6.4% return. On the other hand, if we go one to the left of that center column, and the entire yield curve moves up by 50 basis points, the portfolio would have a 1.2% return.
So
this is
that would be if the Fed increased.
yes,
Okay.
which
And this is-
based on what is currently being forecasted in the market, there isn't a high probability of that happening within the next 12 months.
Correct. So this is basically a shock over a 12-month or over a 1-year horizon. So it's not an instantaneous shock. You walk in tomorrow and, real yields move up 50 basis points. So it assumes on a equalized basis over a 12-month period, rates move up 50 basis points.
And this is actually geared towards our specific portfolio?
This is your portfolio.
Wow.
Yeah. We use Bond Edge software, which allows us to run different types of simulations of changes in the yield curve. So we use it more for, our own, when Lindsay and I manage bond portfolios, to make sure that, where's our vulnerabilities? Is it to rising rates or to declining rates, and what are the expectations, for the next 12 to 24 months for the yield curve movements?
Wow. Looks like T. Rowe Price is coming through for us again.
Yes, we use
4.6% yield.
Yep. And that's actually it's actually a high yield. It's a high yield municipal bond fund, where we're using that more for a total return opportunity. We think there's opportunity for spreads to contract more in muni high yields. You see, we don't really have any domestic or U.S. taxable high yield exposure right now. So we think that market is expensive.
The next few pages are looking at the purchases and sales as well as the holding details within this fund. That goes through page 33. If you have any questions about those, I'm happy to answer them. Otherwise, we can move to page 34, which is the Merrimack water account.
Page 34.
Yes.
Wow, I didn't realize we were so heavily invested in fixed income on that.
So the water account is a capital reserve account. So in terms of capital preservation, it does have a fixed income bias. As the equity markets have more volatility, so you do have a lot more risk in the equity markets as opposed to
Well, and we're
Fixed
restricted to
income.
what we can
exactly.
invest in anyway, so that's preservation of capital is
Yes.
what matters.
Yes.
And I think if
The
you-
principal and income accounts are more heavily weighted into the equity markets.
I was gonna say, if you turn to page 36, it'll show you how the portfolio is constructed, in one clean, easy page. So you can see it's heavily into CDs.
Right.
We're picking up just a little more incremental yield compared to treasuries, even though we do have a treasury in there, that's just
Right.
more, in the front part of the curve, it was giving us more, opportunity for yield versus CD.
Oh, wow.
And you
Yep.
can see it's laddered out to 2023, which is basically 4 years out.
Yep. So it's a $5.9 million account. Current portfolio yield is 2.2%. Our categorization, the cash and enhanced cash piece that's in the upper left hand of page 34, includes that $250,000 T-bill. So in money market cash, there's about $750,000 at this point in time. That T-bill matures next April. And based on the sheet that you handed out, it looks like there's a good number of cash withdrawals, which will be coming over the next couple of months.
Yes.
If we look at page 35, this is looking at the performance of the Merrimack water account. So on a year-to-date basis, if you look at the fourth line down, which is fixed income, the portfolio is up 3.79%. And if you look at the very bottom line, this is the Bloomberg Barclays 1 to 3 year index. It's up 3.41%. So that's a difference of 38 basis points of outperformance there. Over the past 3 months, it has slightly underperformed at about 11 basis points versus that government 1 to 3 year index. So very strong performance in this portfolio. Page 36, as Eric mentioned, is looking at the fixed income holdings specifically. The yield of this portfolio for the fixed income allocation is 1.69%, and the duration is about 1.5 years. So it is on that ladder of going out to a maximum of 4 years for this portfolio. And it is fully invested in U.S. government securities and bank CDs. Page 37 is looking at a shock analysis, similar to the one that we went through before. So once again, just going through various shocks over a 12-month horizon of what could happen to this portfolio given different situations with interest rates moving. We want to skip ahead to page 43. The intervening pages are once again the purchases and sales as well as more holdings detail. Page 43 is looking at the Merrimack Muni account. This account is $5.4 million. Once again, it looks like we have a cash value of $2.2 million here. $1.5 million of that is actually invested in treasuries, so that's based on our classification scheme. If we move to page 44, once again, we're showing strong performance for this account on a year-to-date basis. Fixed income has returned 3.53% versus that index, which is up 3.41%. So that's an outperformance of 12 basis points. Lagging slightly over the past 3 months, 91 basis points versus a 1.03% return. Page 45, we're looking at the individual fixed income holdings through one of our bond edge reports again. For this account, we do have a ladder which goes out to 2022, so that's a 3-year ladder. And the modified duration here is 1 year. And the yield to worst on the portfolio is 1.6%.
It looks like a nice ladder just about every 2 months.
Yeah.
Yes, we do try to space it out so that as you have cash needs, you do have consistent cash flow coming off the portfolio.
Mostly, as we see further down in the agenda, town accounts are in December and back out again in June.
Mm-hmm.
And we don't draw much, or it's rare that we draw something at some other time of year.
Now, the village district, that U.S. Treasury bonds mature at the end of April. So I assume that that's based on communication with when you need money and,
Yes, I mean, they have,
We have a
it actually
copy.
has $1 million in cash at the present time, correct?
It's about 750,000.
Oh, okay.
Yep.
okay, that's livable?
Yeah,
Michelle?
that covers our withdrawals. That's why I've been providing,
That's what
The
the chart here's
spreadsheet?
for.
Oh, okay.
and
Yeah,
we
we
do
have-
have some flexibility. So if there's ever a small gap that you might want us to push things out, you can communicate to that, and we can probably accommodate it. And also, I hadn't put it on the chart, but we anticipate a $500,000 contribution at the beginning of April.
Great.
Where's that coming from?
It's gonna come from anticipated surplus for the fiscal year.
Oh, okay.
Okay, yeah, I hadn't read this yet. It's very useful.
If we skip to page 51 in the book, this is the Merrimack School account. So currently, the total market value of this account is $775,000. It does have a larger cash allocation. We currently have $472,000 for 60% of the account in cash. Our target is to keep about $300 in cash based on conversations, so we are looking to put a little bit more to work in the market for this account. On page 52, looking at performance on a year-to-date basis, it's lagged slightly. That index is up 3.41%, whereas this account is up 3.15%. So an underperformance of about 25 basis points. Page 53, we're once again looking at the Bond Edge report of the fixed income maturities. So this account has a shorter maturity ladder of 1 to 2 years. So the longest maturity that we do have happens in 2021. The modified duration of this account is just about a year, and the yield to worst is 1.6%. And we've also included another shock analysis on this portfolio, similar to the others.
Yeah, it doesn't seem like the under these shock analysis with the fixed income, there's not as much impact, is there?
They are CD portfolios, as opposed to the first one that we were looking at is invested in funds which have a wider asset class variation. So you do have some corporate debt, some
Mortgages,
high yields, munis, mortgages.
Well, this is good stability.
And again,
It
so you're not going to see much interest rate, because it's less than it's a 1 year duration. So interest rate movements, because you have basically in a year the maturity, the portfolio matures. So you're not really taking on a lot of interest rate risk. So that's why those shock scenarios, it's just more for the committee to know that, there is some interest rate risk, but it's really mitigated or muted because of the, we don't have longer maturities in the portfolio.
That's not gonna keep me up at night.
Well, it's a relatively small portfolio,
Right.
so that impacts as well.
Moving on to page 57, we're looking at the Merrimack income account. It's currently $3.15 million. The estimated portfolio yield is 2.69%. We currently have 66% invested in equities, 27.9% in fixed income, and about 6% available in cash. If we move on to page 58, performance for this account has been very strong on a year-to-date basis as well as since inception. So on a year-to-date basis, the total account has returned 16.4% versus the benchmark's 15.6%. And since inception, the account has returned 10.24% versus the benchmark 7.7%. So that's very strong performance there.
It's an annualized number. So that 10.24 is an annualized number for over 2 years.
Fixed income yield is 4.93%.
That's the return.
That's incredible. Last year is good. Past year. Equities 23. Well, it's been a while since we've seen that number.
It's been a very strong year
Yeah.
for
Yeah.
across all asset classes. On page 59, this is very similar to one of the first reports that we looked at for the scholarship account. This is looking at the sector attribution. So similarly to the scholarship account, this portfolio is also heavily weighted towards blended stocks which have a dividend and a growth focus. So we do have some overweights in the real estate and the utility sector once again here, which has added to outperformance of about 3.4%. Page 60 is looking at the fixed income holdings. This portfolio has an average credit rating of AA, AA minus. It is invested in government agencies as well as corporate bonds. So we have increased the credit quality as spreads have tightened. So there's less reward for going out into more risky credits, as Eric mentioned during his part of the presentation. The yield on this portfolio is about 2.06%, and the duration is just about 4 years, which is in line with our targets. Page 61 is another shock analysis on the portfolio. And then we have a number of pages on purchases and sales and the holding detail. And then finally, we get to the Merrimack Principle account, which is $4.7 million with an estimated portfolio yield of 2.4%. This is a growth account, so we have 71% invested in equities, 24% invested in fixed income, and about 4% invested in cash. Moving to page 70, performance has once again been very strong on this account. If you go over on the year-to-date basis, it's returned 17% versus the taxable growth benchmark of 17.05, so right in line there. If you go down to the equity portion, this account has returned 23.08% versus the S&P 500 of 23.16%, so right in line. And we do have outperformance on a since inception basis. The total portfolio has returned just over 10%, and the benchmark has returned 9.76%, so outperformance of about 25 basis points on an annualized basis. Page 71 is looking at the attribution again, so similar story to the past portfolio that we just looked at, more of a growth focus, more of a dividend growth focus, so very strong performance here. Page 72 is looking at the fixed income holdings of this portfolio. So here we have a AA1, AA plus rating. The yield on the portfolio is 2.09%, and we have a modified duration of 4.17 years, so very close to the income portfolio at 4 years, which is right in line with our target. This portfolio has a blend of some CDs, agencies, and corporate debt. Page 73 has a shock analysis of this portfolio, and then the remaining pages are the portfolio holdings detail as well as the purchases and sales for the principal portfolio. And that concludes my my section.
I noticed the purchases only go up to the end of October, so is that Is it that we haven't changed anything in the portfolio since the end of October, or?
We ran the report as of October 31st.
I see, okay. And it's good to see that you're high on Disney again. I love that stock.
It's been a recent addition to the portfolio, yes.
Yeah. Okay. Can't wait to take my grandkids down there.
Okay, had a couple of thoughts here. We are gonna have, in December, probably $2 million coming into the municipal accounts. And then Paul's expecting about 1.7 million reimbursements in mid-June. Do you want to say anything on that, Paul?
No,
7, you said?
yeah, about 1.7. We have a couple of big projects going on right now with the bridge and a couple of big equipment purchases. I think we're buying a trailer and and a loader and things of that sort. So usually in the middle of June, that's what we normally do. We normally give you our deposits in first week or second week in December once tax bills start rolling in, and at the end of the year. Now, I noticed that my accounts is the least performer, to say, at 1.6%. Everybody else seems to be doing much better than me. And I noticed that I'm heavily into the feds, meaning they're heavily invested in feds. How do we change that? Is there a better way with the money? Do you need money different times? Or, because I'm pretty constant with my deposits and my withdrawals over my 15 years here.
I think we've got a shorter time frame here because it comes in December, goes back out in June, whereas the others, the MVD, for example, the money goes in and never comes out. Or comes out less, on a less routine basis.
Yeah, and we're trying to
Because
get back
they've
to
got
that.
if you look at the MVD account, for example, they've got a huge capital reserve fund, huge in my book, for land purchase.
Right.
That happens rarely, but you have to have the money there for when the opportunity comes along. Yours are more an operational,
Yeah, I understand that, but,
kind
you
of
know,
thing.
is there something that we can do at the town that get us a better yield so that, you know, we can make up?
Yeah, so you have a 1.62% yield on the
Right.
portfolio, but your actual return for the year is 3.5%.
Right.
So you have a total return, so the yield plus the portfolio's appreciation adds the 1.6 to 3.5, gives you
Right.
another 2% on
Right, but-
appreciation.
But
So we're typically running this with a 3-year ladder.
Right.
I mean, if there's opportunity to extend it further out, we could generate more yield that way. If we go out to 4 to 5-year finals, that may be able to add a little more income, a little more yield.
But that's up to these guys here, not
Yeah.
me.
Yeah, that's in accordance with your investment policy.
Right. I
So
thought-
we
I
would
figured
have
that
to
was it.
change the policy.
Yeah.
well,
Yeah, that's up
the
to the
investment policy is the same for everybody.
Is it?
Supposed to be.
Oh,
Yeah.
that eliminates that.
Well, under the common funds, you're allowed equities.
No, we're just talking municipal funds.
Right.
We
Which are all
have,
CDs and treasuries.
we've taken direction from the trustees typically as to what the maximum maturity ladder can be for the various accounts, which is why water goes out to 4 years compared to the muni account, which only goes out to 3. So I do recall that from past meetings.
Yeah.
Which,
Well-
if you go a bit further out on the scale, you do have the opportunity to buy
I-
higher.
Yes, but it's
So-
their money.
Yeah.
I'm just the check writer.
But I think Paul brings up a good point. We might be able to extend that a little bit because very consistently, we get this chunk of money in December and we take it back, most of it, back in June. But there's still a floor under all of that of about $2.5 million that is less likely to be moving. And so that 2.5 million, might be a little bit more than that, 2 3/4, whatever, in that range. Maybe we can extend that ladder a bit.
Okay.
So if you want to take a look at that, and as we roll things over, I would say maybe we can extend some of that.
Yeah, because I notice I have some stuff coming, well, the account has stuff coming due next 2 to 3 months.
So there's plenty of cash for even though the 2 million comes in, we've earmarked the cash for June of like 1.5 million.
Right.
So there's always that availability, the short-term liquidity is always in the portfolio. So if we could take the longer term that's not going to be used, we could probably roll that out a little further.
Yeah, and I think that's what Chris is saying there, to look at that portion of it to get a
We
little
can
bit more
make it
yield.
we can write something up, the investment policy, and send it over to you for approval.
Okay?
Is it something to do with the mix too? Because I noticed the muni accounts heavily invested in U.S. Treasuries, and the only high yield, Morgan Stanley's doing well, but there's no like T. Rowe Price or anything in that mix.
It's a capital preservation account, so we can't invest in high yield products based
Oh,
on
I
the
see.
IPS.
Yeah, it only can be government securities or
Oh,
government.
okay, so there is an impact there.
Yes.
Okay.
So all of the CDs are FDIC insured. So they're very secure securities.
Does that,
So you're getting a little more
That
yield
makes
on it,
sense.
yeah.
Oh, it makes sense that
You
we
guys
wanna
are safer.
preserve it. We're safe.
Yeah.
And I'm not saying go out there and give me 27%. I'm just saying that, looking at being $5 million, it's,
We could probably, by moving out the curve an additional year or two for final maturities, we could add a little more income or a little more yield. to
and
the
still
portfolio.
be safer.
Yeah, it's
and
going to
still be
be
safe.
either in
It's-
agencies
yeah,
or
right.
treasuries or CDs.
I'm heavily, well, the fund, not
Yeah.
the fund's heavily invested in government.
Yeah,
you know.
yeah, and that's the
And we have
requirement.
to be, that's not our choice.
Yeah, right.
That's required by the state.
State, right. Yeah, so our hands are tied, just like my money is tied. I can't go out and
Yeah.
invest in Disney. So, no, that's the only thing I saw there, but yeah, if there was a better way to do it, Chris, I'm willing to work with you guys to see what we have, and
Well, stop asking for money back.
I wish I could. I'm trying to actually get them back into a capital reserve savings account kind of deal versus a appropriation account, ins
Well,
and outs.
I had a similar discussion with the school superintendent a couple of days ago, that where their focus is and so forth, and they're probably going to be changing as the time moves on, because they've had very little use of capital reserve funds. They got a $74 million budget, 700,000 capital reserve funds. And you look at the town with a $33 million budget,
Around.
and $5 million in capital reserve funds. So there's a different focus and different situations, because they can't hold money the way the town can.
Right.
thank you, Lindsay.
You're welcome.
And Judy, the team is really impressive.
Thank you.
Especially the shock analysis.
I'm looking at the common funds, and the focus on the principal account, as you mentioned, is a little bit more growth. But the income side, the income portfolio is not hugely different. That's doing very well in terms of growth as well. I think you said 16.2% or someplace in that range.
Yep.
One of the problems we have there is, and this is again part of what I'm trying to, we're trying to schedule some meetings with the school board, because we do have unusual amounts of money coming because of the strength of the general economy. And so they can't count on that every year, but it is something that they want to start taking a look at. So we may be talking to them beginning of the year and looking at redirecting some of that more into cash so that they can do some projects. Okay, I don't have anything else. Do you have anything, Michelle? For Cambridge Trust?
No.
Did you want to point out anything on your spreadsheet that's new?
Sure. We adjusted some of the timeframes,
Okay,
kind of in light of having this information where I can see the laddering, and start to work with that as we plan things out. And as I say, we have some flexibility as far as when the submissions are expected to be processed. The major addition here is the bottom third, wells 4 and 5 treatment plant, $673,000. The treatment plant is set to go live next July, so the second quarter of calendar year 2020, from April to June is when we expect that those funds are going to be spent from MVD operating, and we just don't know if they're going to come in one billing or if it's going to be spread over that quarter. But as I know more, I will let you know. We have several projects going, 3 treatment plants that are underway, as well as a booster station. So we have a lot going on, and as one thing runs into an issue, sometimes it shifts the other projects because we have contractors working on multiple projects, so the dates can move around. So I keep updating this as I learn information, and I will pass it along as we have any changes. So if you have any questions on anything, feel free to let me know.
no, I'll just comment that most of the treatment plan money is bonded. It's not coming entirely out of capital reserve funds. There's a contribution, but
Yeah, we
these are huge bond issues, basically.
we obtained both drinking water, groundwater grants, loans, and then SRF. So we will draw down on all of that before we expend and then seek reimbursement. And actually, we're also continuing to look at additional grants and funding. So if that changes, we will let you know accordingly.
Great.
Okay. You guys all have copies of that, so you
We
can
do, yeah.
modify as necessary. I think that's everything there. I have a couple of things in
Judy passed out an MS9. That looks pretty good.
And I did as well. Did everybody get 8.5 page, 8.5 by 11 page?
Yeah.
What I did is I took, in anticipation of what we're doing for the town's annual report, which is printed on a roughly that size page, whereas everything else that we have these days comes out on either something that you have to scroll over, or it just overwhelms anything of printability. So I just did this as a kind of a drill. You can take a look at it, see if there's things we want to add or subtract, and
It's a good summation of all the funds.
we can do the same thing with the capital reserve funds and so forth to get it into a format will fit on the printed page. Otherwise, the stuff that comes out of the DRA portal would be like a 50 or 60 page block of
Did the
in the annual
benefic-
report.
do the beneficiaries, are they aware of the income on their various funds? Like to take the school funds, for example?
Yes.
Oh, okay. Was
I've-
that what you talked to the superintendent about?
Right.
Oh, okay.
So we will schedule some time. It was just a telephone conversation, and Matt was sitting in on it. So we'll schedule some time with them to figure out what kind of projects they want to take on. But we don't want to be involved in their budget process.
Right.
And some of the bequests specifically say, this is not to replace normal budget things. You gotta do what you're supposed to do and not rely on us. This is for enhancement. So, what else is coming up here? Watkins Town Forest. We haven't had any changes in that. I sent out a note to the town, the Conservation Commission, the school district, and just to notify them that we're not gonna be doing anything there for the next 4
5.
years, 2025,
Oh, I thought you said 5 years.
5 years, yeah, 2025, 2026. And I guess they're all okay with that. The main thing was we wanted to, if they're gonna do any harvesting on the Mitchell Street Forest,
Right.
we would wanna coordinate with them.
Yeah, we wanted to give those trees five more years of growth.
Yeah. I do have a bill from the Last Rest Cemetery for $11,833.72. Need a motion to approve and pay that.
Okay, I move that we pay the bill from the Last Rest Cemetery.
And I'll second that. All in favor?
Aye.
Interesting coincidence that that's exactly the same amount as the bill was last year. That almost never
Oh, really?
happens.
Who's running that right now? Who's the chair of that trust?
Well, Nancy King is the
Nancy Key?
lead finance.
Who's the chair?
The chair is Lenny Worcester,
Oh, okay.
and
Well, he's got a lot of hats in town.
yes, yes. And Nancy King is in charge of the finance portion of the cemetery.
Nancy King, okay.
So here's a copy of the bill and a letter of instruction to pay it. And I can email that to you if you want it, just so it's scanned.
Doesn't matter.
Okay.
I can take this with me?
Yes. We've also had a scholarship from the Watson Fund request. And we've already pre-approved those, so that's been paid.
Oh, it's already been paid for Leanne. Where does she go to school?
Maine School of Art, College of Art, excuse me.
Maine College of Art, okay.
And their billing is intriguing in the sense that it's all small print and single line, and it goes to 2 pages with all of the ins and outs and this kind of aid and that kind of aid and credits, and it's a crazy kind of thing. If you look at these days at, I don't know if any of you have kids in college, but the billing systems and the sources of payments, just very complex. And what else? I don't know if you have anything. We went to the New Hampshire Municipal Association training. That used to be put on by Department of Justice. They still do it, but they don't invite you guys anymore, which is too bad.
Well, there were banks there.
Not in attendance at the training sessions.
Oh, at
The
the
banks
training,
that,
right,
that were there were vendors.
right.
Yeah, I guess if you were a vendor, you could sneak into some of the other sessions. Don't know how that works.
In fact,
But I'm gonna say that nothing,
Citizens gave me this pen. So.
nothing spectacular or new came out of the sessions. That, they did ask, who likes, or has everybody used the new portal? Yes. Yeah, all the hands go up. Does everybody like it? Whew, not a hand in the room.
No, that was good training.
And for Paul's benefit, we did ask about how other trustees are printing and reducing stuff. And a lot of them are not putting detailed information in their town reports. They're referring people to their websites and the like. So, other than that, I don't think anything new came out of the presentations that we sat in on. But it's nice to go and keep ourselves up to date. What else we got here? Oh, the possible school board meeting, I think that'll come at the beginning of the year. They're trying to figure out the, so we don't overlap with the budget stuff. And
Capital Reserve Fund deposits,
we already talked
We
about
already
that.
talked
Paul,
about
Paul
that.
mentioned that.
okay.
And we talked about the annual meeting report, so that covers all of those things. There's no meeting in December. Our next meeting is January 17th. And then the next one after that is February 21st.
Yep, I already have
I'm
that.
I'm not sure when school vacation week is or if that impacts us.
It'll be the next week.
Yeah, okay. I used to think of it as being around George Washington's birthday, but we don't celebrate that anymore. Is there anything else we need to
No, that,
And
bring
you'll
up?
let us know what meeting you'd like us to attend next?
I
Probably be
think
in March.
probably May or June.
oh, okay.
We usually do that so we can get the major transfer back in time for the town and close all that stuff out by June 30th. So I'm gonna say May. Do you have anything that we got coming up, Paul, that needs to be addressed?
I'm just trying to run through my projects and where we stand. The bridge should be completed. That's the big one. We'll try to get some of the other capital reserve stuff bought before. I could try to have it for you for May, most likely probably June, but I can try. I could give you a big one in May and then maybe a supplemental in June if I get a couple of big payments,
Well, usually we meet the third week,
right?
and that only gives us about 7 or 8, 10 days to make the transfer, which we can do, because it's usually a wire transfer anyway.
Right, right. What I could do is, I'll try to have the bulk of it to you for May, because the bulk will be completed, and then if I have anything big between the May meeting and June, I'll ask for a supplemental in June. Is that okay?
Sure, that's fine. So I'm gonna say at this point, we'll talk about May,
Okay.
but don't see anything that's urgent, just the usual review and portfolio update. And we'll see how the world is turning after the March primaries. And I guess that's it. Do we have a motion to adjourn?
I move we adjourn.
And I will second, and we are adjourned as of 9:40.
9:40.